valuation is important. Like anywhere where people are investing money or taking out money, they need to value and understand that what kind of money they are going to get or what kind of return are going to get. So valuation comes at two stages. When you are entering into a company, that is where you value a company and find out the price, and when you are exiting, and again you find out what is the kind of return you are getting. So its valuation is simple, like how a stock market works, but that is also valuation, but that is visible valuation. There are ways where you value a non-listed company, and ultimately it's all about the money, so how much return you get. I would say there are traditional valuations which used to happen where it was basically for investments and for regulatory purpose. Like there are regulations where a FEMA or someone outside India who is investing into a company, then there are FEMA, Foreign Exchange Management Act. There are regulations related to those where you have to get a certain benchmark prices beyond which you have to value, below which you can't value or can't put in money. So those are traditional conventional valuation practices. Nowadays there are a lot of different valuation practices coming in, which is like a dispute valuation, a family dispute, or a company dispute valuation, where you need to value each of the businesses separately. So that's an offshoot in valuation. There are valuations which are related to non-listed companies hunting for investments for growth and everything. Again, there are intangible valuations. Now, intangible has a huge market potential because what a brand value is, what the patent value is. These are actually required after a company's purchase. Let's say Flipkart acquires Snapdeal. Now, to account the value of Snapdeal in Flipkart's book, they'll break up the assets and say, okay, the name Snapdeal, the brand, is valued this much. So let's say Snapdeal is valued at 1 billion. That's what they wanted from Flipkart. So if the deal happened at 1 billion, what is the breakup of 1 billion? That is called purchase price allocation. So you purchase Snapdeal at 1 billion, and then you break Snapdeal into customer relationships, web portal can be valued, which is an intangible. Brand Snapdeal can be valued. Again, vendor relationships can be valued. So those are all intangible valuation. Primarily, again, those are counted in the books, and then income tax. So goodwill is then valued, and based on which your fixed assets are created, based on which depreciation, amortization is received. So from income tax point of view, these are all big valuation numbers, and the income tax officers do get into all those valuations. So that is an offshoot or a new valuation. With changing industry, Indian accounting standard, the new accounting standard that India has come up with. So though the accounting standard wants valuation every year for the assets that they have. So every year now the books of accounts will be fair valued, or the assets will be fair valued, so that actual picture of valuation comes up and not the historical cost. So if I purchase land or a brand at 100 rupees, and after 15 years also the land is not going to cost at 100 rupees, it's going to be like 1,500 rupees. So your book should actually give out those numbers and not a historical cost. So those are new types of valuation assignments that's coming up. A classic case would be dispute between the Ambani brothers. Now they had a one big business empire. Now they wanted to split. So how are the businesses going to split? Listed companies, everyone knows what was the value of the listed companies then. But what about the numerous unlisted companies that they had? Which brother will get what? And if they are divided equally into both Ambanis, then what is the value of each unlisted company, and how they will be separated so that each one will get 50% of the total empire? So that is dispute business.